Good afternoon, everyone. It's Mitch Goldberg. It's time for Be the Boss of Your Money, your post-market show every Monday through Thursday at 4:30 p.m. Thank you so much for joining me. We've got a lot to cover today. Today is a unique day, not in terms of the day being a down day in the market. We had a day like this just over a week ago, a pretty substantial down day. Today is a little different. It feels a little different, and it feels like it's a little bit more harsh. And it feels like there are a number of changes that investors have to grapple with. Predominantly, big changes coming up in interest rates. What's the deal with interest rates? What does this mean for you, for your life? Does this really change anything, or does it change a whole lot? That's the point today. That's what we're going to talk about. So stick with me. This is going to be a really good show. I've got a list and list of things we're going to cover, and I want to fly right through it, and I'm going to put it together in a nice, neat package for you. So let's roll the quick intro, and then we are going to get started. Here we go. Thank you for taking the time. This is Be the Boss of Your Money, your post-market show. Today, interest rates have gone up quite substantially. They've gone up quite substantially in the last week. But investors are starting to take it to heart just now. Why now? Why weren't investors worried about higher interest rates? A week ago, everybody was saying they're so big and bad and brave and bold. If interest rates go higher, it means nothing. I'm going to hold on to my stocks. It's not going to change a thing for me. Josh, I see you out there. Thank you. So if you're just joining us now, we're talking about today's market interest rates. And is this truly a regime change that has kept us around 1.15 to 1.35% on the 10-year Treasury? Are we now looking at a new regime of 1.5 to 2%, maybe even breaking out of that? I don't think we break out of it just yet. Anything can happen. But I do think that once rates get up to about where they were last March, about 1.75, 1.78%, rates plunged all the way down to 1.12%. So we're talking about long-term rates. We're talking about the rate in the 10-year Treasury bond. It's the most important thing that we follow when it comes to bonds and interest rates, and so many things are tied to it. While you're watching this, if you have any questions about the content that we're talking about today, personal finance, investing in general, you can ask me. Hit me up in the comments. I'd love to answer you. Interacting with you is my favorite part of doing this. So I would love to hear from you. So hit me up with your questions in the comments. Words of wisdom, words of encouragement are always appreciated. If you have an experience that you'd like to share about your investing, either misfortunes, mishaps, or the marvelous, you let me know. I want to hear about it, and I think that would be a lot of fun. So let's talk about what's going on today. When interest rates rise, I'm talking long-term interest rates, it hurts high-duration stocks. So now I'm talking lingo. What the hell is a high-duration stock? Did I say hell on this? It's okay. A high duration stock means a stock with a high valuation, a stock that has been up a lot, that's trading at a pretty high ratio of, let's say, sales to price to sales, or price to earnings ratio. And these are just common ways that we use to value stocks. They're not the end all and be all of valuing stocks. But the more richly valued a stock, the more it says that investors value that company's future earnings. So if a company is trading at 100 times earnings today, very pricey stock, 100 times earnings is considered a lot, or a company that's losing money, so it doesn't even have a P ratio, but you think they're going to earn a lot of money in the next 5 years, for example, you're willing to pay up for earnings that they may get because you think those earnings are going to be worth so much. But when you discount the future earnings to the current moment, to the current place and time that we are in now, you use prevailing interest rates. And if the interest rates are higher, it makes those future earnings worth less money now. And since so many tech stocks are traded on on expectations of what their future earnings are going to be, these stocks become valued less. Their future earnings become less valuable. And a lot of them, it's iffy, even if they're going to make the earnings expectations that investors have set for them. So there's a lot of risk to that, but higher interest rates does make the risk come out more. So that is the overall synopsis of what's going on. Now, it's not necessarily just that interest rates go up or how much interest rates go up. That is not the only thing that counts. Something else that counts is the speed of how quickly interest rates go up. If interest rates go from where they were a week ago, like 1.3%, to now a little over 1.5%, if it took, a few months for that to happen, you know, it wouldn't be that big of a deal. But when it happens quick, it causes confusion. Portfolio managers feel compelled to make sudden, spontaneous, just quick, rapid changes. They shoot first, ask questions later. It causes dislocations in the market. You throw in some algorithmic trading, and before you know it, you've got stocks that are taking it on the chin and going down a lot. Taking it on the chin is an old boxing analogy. You get hit in the chin, that's the knockout spot, and okay. So that's what's going on. Now, who does it affect? Well, it definitely affects tech stocks, not all tech stocks. And this is the problem with using general terms, but for purposes of getting through the day, let's just talk in general terms. Tech stocks generally have become richly valued. These stocks are up huge since the start of the pandemic. They have made everybody's portfolio who has them look better because they've gone up so much. And you probably have exposure to them. I don't see how you don't. If you are just an index investor, let's say you just are investing in the S&P 500 index fund, okay? You cannot invest directly into an index. Just, you have to use a fund that tracks or mimics the index. But let's say you're in an S&P 500 index fund. That's about almost 40% in technology. Now, by any stretch, would you say a mutual fund or an exchange traded fund, if it's 40% in one sector, you'd have to agree with me that that is a very heavily concentrated portfolio. Most people buy the S&P 500 for a few reasons. They hear that it has low expenses. True. It's diversified. See, that's where it's not so true. The S&P 500 is not as diversified as people think. Well, you ask, how can it not be diversified? It has 500 stocks, 500 companies. It actually has like 504 stocks because some companies have Class A and Class B shares, but we'll get into that another day. Let's just say 500 members in the S&P 500. That sounds pretty, mixed, pretty, what's the word I'm looking for? Pretty diversified, right? Okay. And diversification, just so you know, that's a strategy that we use to minimize risk. It doesn't necessarily protect your portfolio from going down, though, in a generally down market. You should know that. So if you're super diversified, odds are your overall portfolio still went down today because we had a generally down market. However, the S&P 500, about 28% of the index is just in the top 10 stocks. So just by having money in that index in the S&P 500, you have the same stocks that are that are tanking right now. In fact, I'm surprised the S&P 500 actually held up as well as it did. But there's a reason why the Dow and the S&P 500 held up better than the Nasdaq, because the Nasdaq is really heavily into tech stocks. Okay, so I'm going to show you some things on the screen. I want this to be very educational for you, uh, super educational for you. So let's do a share screen. Okay, pop myself up in the corner over here. Okay, this is VOO. VOO is the ticker symbol. It's the S&P 500 ETF. It's a widely used ETF, certainly one that I am comfortable with uh, for my clientele. So, if you're going to invest in an S&P 500 fund, this is pretty much the creme de la creme because its expense ratio is 0.03. It's for $100,000, it costs like $30 a year. That's a really low expense ratio, but nonetheless, it is an S&P 500 index fund, and its biggest competitor is the Spiders SPY, and that is instead of 3 basis points, it's 9 basis points. It's higher, but still, we're talking about pretty insignificant numbers. I see Andrew is out there as well. Guys, great to see you, Andrew and Josh. While you're watching this, if you have any questions, you know what to do. Hit me up in the comments, okay? The average P ratio is almost 30, which is historically very high, okay? Uh, but what's in this, okay? It's doing fine this year, and year to date, it's up about 18%. But if you look at it, 35% technology. There's, the communication sector also has a lot of technology in it, like Netflix, for example. Um, I know Netflix, is it a tech stock or is it a communication stock? We could slice and dice the characterizations and nomenclature as much as we want to classify stocks. But basically, it's close to 40% technology. And then you've got Apple, Microsoft, Amazon, Facebook, Alphabet, which is Google, Tesla, Nvidia, and then the only two in the top 10 that are not uh, somehow tech related are Berkshire Hathaway and Berkshire Hathaway and JP Morgan. Let me make sure I speak into the microphone. Sorry about that. All right. So and let me make this a little bigger. All right, that should help. Let me make this, just see if I can make that bigger so you can follow along here. Okay, there. That's a lot better. So the top 10 holdings are almost 30% of the portfolio. In any stretch, it's not really a diversified portfolio. And that's why if you are in the market, you're feeling the pain, whether if you know it or not. I know a lot of people think, "Oh, I'm just in the S&P 500 index fund. I don't have to worry about this stuff." If you look at what it's made out of, yeah, I'm not saying you have to worry. It really, worrying about the market depends on your age, your time horizon to needing your money. Those are the things that you should make you worry or not worry about your investments. I don't worry because the stock market went down. The market goes up and down, and it's known to have some substantial bear markets every now and then. My worries or concerns are shaped around a client's needs. Client's going to need money in 5 years, or let's say, for example, a client is 65 or 70. I don't want them 100% in the market. They should be in an asset allocation of stocks, bonds, and cash that's appropriate for their age, for their time horizon, and based on whatever kind of income they have. As opposed to somebody who's 30 years old or 40 years old, they've got such a long runway of time ahead of them. I don't worry for them about the stock market because a down market is their friend. I'm happy. The market's going down. You should be happy. A lot of people don't realize that. A lot of people don't realize that a down market is their friend, not their enemy. If you're an investor, if you're a trader, it's a different story. A down and down and down market means you can't trade for investments, stocks up and down, what have you. But let's move on. And if you take a look at that, and then you take a look at a fund with real high duration stocks. Sorry to scroll so quickly. I hope I don't give you a headache. And let's say we take a look at the ARC fund. Okay. Are you familiar with the ARC fund? That's the Kathy Woods. That's the main fund managed by Kathy Woods, a very popular fund manager, and ARC Innovation Fund. Um, and that fund is not exactly filled up with Amazon and Google and Apple. That is filled up with tech stocks, but much a much different cohort of tech stocks. So this fund did even worse than the Nasdaq today. And it's not because it's a bad fund, by the way. It's because you have to know what the fund's purpose is and what it invests in. You can't say, oh, the tech fund was down, but the energy stock fund was up. So therefore, the energy stock fund is a good fund and the tech stock fund is a bad fund. No, you have to look at how the tech fund was made, what's it made out of, what are the stock components, and then you can make your own determination. But when a fund says innovation, you better believe they're swinging for the fences and they're taking a lot of risks. And every now and then, the fund's going to drop a lot, and you have to be comfortable holding the bag. If you're not, you shouldn't be in that particular fund. So if you look at what's in this fund, it's down about 3% year to date, while the S&P 500 is up about 18% year to date. All right. It's almost all United States, but look what's in this one: Tesla, Teladoc, Roku, Unity, Coinbase, Zoom, Square, Shopify, Spotify, Twilio. All of these are miraculous companies that have achieved incredible things. Zoom, look at Zoom, look at Tesla. Just they're all incredible companies. But that doesn't speak to valuation and the ability to make money. And in a higher interest rate environment, these companies are so richly valued that they are super sensitive to small changes in interest rates. So you have to know what you own. And if you want to own the ARC fund, just, buyer beware. Okay. Let's take a look at some of the other stuff that I'm looking at that I want to share with you. All right. Sorry you're, staring at my screen here, a blank screen. You see my screensaver. Okay. But let's take a look at the market. So the Dow is down. Better yet, let's look at U.S. markets. Okay. Dow is down 569 points. A week ago, it was on TV because the Dow was down 615 points. Even though the Dow wasn't as down quite as much as, let me make this a little bit bigger, as last week, I still think today's drop is more significant. Last week had something to do with the Chinese real estate company Evergrande, which I said it's an international non-event for investors. But if you look at this here, okay, the Nasdaq was down the most, down at 2.8%. S&P was it was down 2, and the Dow was down 1.6%. Oil was off a little bit, but look at gold. Gold is down to $1,733. People keep saying, if there's inflation, you should buy gold. We've been talking about this, that just gold has shown no expression, no prevalence of even a whiff of inflation. So either gold is broken or inflation's not as bad as you think. And here's the granddaddy number of the day. This here is the 10-year treasury at 1.54%. And then you see here the VIX at 23. I always tell you, over 20, market goes down. Under 20, when the VIX is under 20, the market goes up. The VIX exploded higher today, up 24%, which is a pretty darn big move. We've seen bigger moves than that, but that's a pretty big move. And then you take a look at the Russell 2000 down 2.25% compared to the Nasdaq down 2.83%. And there you have it, folks. That's That's the deal. That's why you you see the Nasdaq down so much more because it's so much more skewed toward technology. We've got a quick question here from Carmine D. Dominico. I hope I pronounced that correctly. What is the most important change in the financial climate in decades? Okay, well, yeah, I kind of started with that in the thumbnail. So you want to know, Mitch, what the hell's the change you're talking about? It's so big. Uh, the biggest change that we could be seeing in decades is the interest rate environment. The biggest change that we could see right now that we could be seeing is the interest rate environment going from an ever lower interest rate environment to a higher interest rate environment. Rates have been going down since 1980. So this is, that's one hell of a run, 41 years. But more importantly, since the Great Recession, we've had QE, quantitative easing after quantitative easing. We've had all kinds of stimulus, all kinds of government spending, and granted, for good reason. And we had a pandemic, so we spent a lot of money to keep people in their homes and to keep people from waiting on bread lines and to get people jabs for the vaccine. There's just so much money, trillions and trillions of dollars. We're at the end of that. Okay. We're at the end of stimulus, of monetary stimulus from the Federal Reserve. The Federal Reserve, once it stops buying its bonds, they buy $120 billion of bonds. They're going to start tapering by the end of this year, meaning they're going to reduce the amount they buy to 100 billion, then 90 billion until they're zero. They're getting away from stimulus. And then the next thing is they start to raise rates. And 9 out of 18 Fed governors have said they expect interest rates to rise by the end of next year. We used to think not till the end of 2023 or even 2024. So, and the Fed says that inflation is now a little bit more persistent and a little higher than we expected. So that's the big change. It's just that we're going from a regime of more stimulus to less stimulus, and investors are trying to figure out how does that affect the stock market, because if you think about it, we're all invested in the market, and we're all one way or another depending on the market to be higher. We're all depending on the market one way or another to be higher when we need our money, when we retire one day. So I hope that answered the question. I am bloviating a bit. And we have a question from Rhonda. Hey, Rhonda, nice to see you. I haven't seen you for a while. Very nice to see you. What to do about Moderna down 25? All right, so two things. I mean, in this live stream, I don't like to comment on individual stocks, but I will tell you this. I think it was Glaxo or Sanofi, I think it was Glaxo, one of the very big, though, European drug companies who is close to coming out with their own mRNA COVID vaccine, actually said, we're not going to bother with an mRNA vaccine because Pfizer slash BioNTech and Moderna basically have the market now to themselves. The thing about Moderna is that the mRNA technology, you could use that to like plug and play theoretically to solve an infinite amount of diseases. So the stock, from what I know about it, from what I've read about it, is extraordinarily richly valued, which is one of the reasons why higher interest rates affects a Moderna a lot more than, let's say, higher interest rates would affect Chevron or some other staid, more boring kind of company. So that's what I think. If it comes down enough, I'll take a closer look at it. But you have to expect that their future is going to be so unbelievably bright that you would want to own the stock today. Keep in mind, I've seen so many winners that were perceived as so overly crazy valued, like Amazon, that have truly become miracle home runs. So I don't think there's anything wrong with owning a stock like a Moderna, as long as you're comfortable taking that risk, and you know how much of your portfolio you want in that one stock. Listen, folks, I think I want to just switch my camera angle. I want to talk to you really frankly about this. I think one of the biggest takeaways from last week's drop and today is that, in my view, we're going to start seeing more of these gyrations in the market. I think it's going to become pretty common to see 300 to, let's say, 700 point down days in the market. You're very welcome, Rhonda, and it's my pleasure. Thank you so much for watching. You're always welcome to DM me or call, and we could talk specific stocks, portfolio, that sort of thing. It's just, it's a live stream, and got to be careful with what I say. Okay, thank you. You're very welcome. So I think this is going to become commonplace. So here's another way to answer Carmine's question about what's the big regime change. We have a few leaping points here where it looks like we're making the move from those great screen stocks, work from home, stay at home stocks that carry the market to incredible heights the last 18 months. And we're starting to think in terms of, is that trade over? Should we be moving more toward the cyclical, economically sensitive trade? So what does that mean? Stocks that are not richly valued, okay, that are not high duration stocks, relatively speaking, they could do better, okay, relative to the more highly valued stocks. That's what that means. And you take a look at the old, normal stocks, industrial kind of companies, the Caterpillars, the Boeings of the world, energy stocks, the Chevrons, Exxon Mobils of the world. You take a look at material stocks like a Dow Chemical, and financials, especially financials, the JP Morgans, the Bank of Americas of the world. I'm going to exclude Wells Fargo at the moment because that company is just having just an endless amount of regulatory problems, and deservedly so. But it just seems like they can't get out of their own way. It's always like every day it's Wells Fargo in the news. It's like whenever you hear about Wells Fargo in the news, it's like, here it comes. What, another multi-$10 million fine that they have to pay? I'm a little tired of it. So I'm avoiding it. Okay. So that's what I wanted to share with you, is that, and we saw something very similar to this in the beginning of this year, when the 10-year Treasury yield went to 1.78%. And we saw the same thing. Everybody was into the rotation trade, the reflation trade. We were buying, cruise lines, airlines, anything that has anything to do with people getting back to normal. Restaurants, travel and leisure, that's what we call it. And then the Delta variant spread like crazy, and we got back into the work from home, stay at home screen stocks, and the reopening trade was pushed back. Well, that is already coming back, because there are so many people who are vaxxed now, and so many people who've had the Delta variant, that it's basically new infections are on the way down now. And it looks like we're getting past the big surge. Okay. I'm not saying we have something to celebrate. I'm saying it looks like it looks like it's peaked, and that encourages investors to go buy economically sensitive companies. Now, last thing I want to do is I want to actually bring you back to my screen, because I want to wrap this up, and I feel like I didn't show you everything that I wanted to show you. So let me just pop myself up in here. GE was up today. Great. These are some of the industrial stocks that were up today. So industrial stocks didn't have too bad of a day, but I want to show you the sectors that I look at every day, and then we'll let you go. Okay. Energy was the winning sector today, barely up, but nonetheless up. Energy could do well when interest rates go up. And if there's inflation, that's even better for energy stocks. Energy companies they thrive on inflation. Okay. Real estate was off a little, industrials off a little, materials XLB off a little bit, financials off a little bit. The real pounding of the day came from, okay, discretion, healthcare, communications, and technology. And this is one reason why I think you could have up stocks and a down market. Because understand that the large mega cap tech stocks are so big that if they go down, they drag the S&P 500 down with them. But it doesn't mean you can't make money in other areas like the reopening trade, economically sensitive stocks like energy and like financials and like some of the industrials. That's the place that I would focus on if you expect interest rates to continue to rise. I don't know if interest rates are going to rise at quite the speed that they're rising now. And the last thing I'm going to show you, I promise, the very last thing is you can keep a lid on rates. Well, I'll show you two things. Crypto is down across the board. And that has a lot to do with if we're starting to tighten and we're starting to get out of stimulus, then why do we really need to worry about crypto as an inflation hedge against dollar debasement? But this is what I want to show you, okay? Let me see if I can make this even bigger, all right? This is the 10-year Treasury. Oh, come on. That's not what I wanted to show you. The 10-year Treasury, I'm a little click happy today, went out at 1.53%, but the 10-year German Treasury is only at 0.19%, Japan 0.07%, and England 0.99%. So foreign buyers at some point will start buying U.S. Treasuries because there's such a bargain. There's such a great rate compared to their home country bonds. And I think that will, for now at least, keep a temporary lid on how high Treasury yields could go. All right. We covered a lot of things today. Is there anything that I missed before everybody hops off the call? It looks like we covered like everything that I wanted to. Wow. We did it. Congratulations. Thank you very much for watching. I'm really happy about this. And I hope to see all of you tomorrow. And again, if you have any questions, you're welcome to DM me, reach out direct, or just call your local financial advisor. Make sure that you use an independent, because we independents are the ones who work directly for you and no one else in between. Thank you and have a great day. Bye.